Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing DouYu stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. DouYu is a video streaming service. It is like the Twitch of China. It primarily focuses on video game live streaming and includes official broadcasts of eSports competitions. It also has live broadcasts for many different things such as cooking, anime, outdoor activities, etc. It collaborates with participants on eSports and has gained access to a wide variety of premium eSports content. This helps the company attract viewers and enhances the user experience. It has 174 million monthly active users compared to Twitch's 140 million. DouYu also has 21 million paying users. Huya is a competitor of DouYu. Huya has 180 million monthly active users. It is DouYu's direct competitor. Both companies are really similar and control 80% of China's video live streaming market. Tencent owns 37% of DouYu and 47% of Huya. Huya is listed on the Nasdaq with a market cap of $2.5 billion. Tencent wanted to merge these companies together, but it was denied by China's market regulator. The regulator said the merger would violate antitrust laws. Antitrust pretty much means a monopoly. If these two companies merged, it would create a monopoly, which is illegal unless it is a government-controlled monopoly. The company is headquartered in Wuhan, China, and was founded in 2014. It started trading in 2019 and can be found on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $378 a share and they have 324 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 2018, positive in 2019 and 2020. We can't get their trailing 12-month free cash flow, so I just used 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. And you can see that was positive in 19 and 20, negative in the trailing 12 months. Revenue is the sales for the company, and that grows about 2.5 times from 2018 to 2020. It decreased a little bit in the trailing 12 months though. This is the company's income statement. All their numbers are in Chinese yuan. It's pronounced yuan, not yuan. But I converted all their numbers to US dollars in my Excel spreadsheet. The top line is the revenue of the sales. Over 90% of their revenue comes from live streaming gifts. Under 10% comes from advertising. So there's a ton of opportunity for them to sell advertising space, because when you have so many people going to your app, you have the ability to sell a lot of advertising space and get good money for it. But almost all their revenue comes from people giving gifts to live streamers. The company takes a cut of those gifts. And the gift could be as low as 1 penny up to a few $100s. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. About 8% of the cost of revenue goes to maintaining their app. There are a lot of bandwidth costs because there's so many people visiting their application and using their service. But most of their revenue comes from revenue sharing fees and content costs. Similar to Netflix, Netflix has to pay a lot of money. It has to pay all the producers of the movies and TV shows. Similar to this company, they have to pay a lot of money to the creators of the video games. Plus, they do share a lot of money with eSports as well. So they have a really high cost of revenue as a percent of their revenue. So their gross profit margins aren't so great, and they've been getting worse. Their gross profit is lower in the trailing 12 months than it was in 2019. And they had higher revenue in the trailing 12 months, a lot higher than in 2019. Because all the various fees and licenses to have the games on their platform have gone up a lot the past year. But I imagine once they break through 10 billion yuan, especially when they get up to 12 billion, 15 billion, then economies of scale set in and they'll become more profitable. Below gross profit is their operating expenses. So about half of their operating expenses are sales and marketing. They want to attract new users and new streamers to their site. Research and development is $416 million, and then payroll costs for their employees is $375 million. They only had positive operating income in 2020, negative in the other years. They pretty much have no debt, so they have no interest payments on their debt. And the bottom line of the income statement is their net income, which was positive in 2019 and 20, negative in the trailing 12 months and 2018. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they did have negative operating cash flow in 2018, positive in 2019, their highest ever, $813 million, and also positive in 2020. They did spend a good amount in CapEx in 2018 and 19, nothing in 2020. They don't fund their business on debt. They just fund it on capital stock. They issued over $4 billion in 2018 and $3.4 billion in 2019. So when a company issues capital stock, that increases the shares outstanding, making your shares less valuable. So they did have negative free cash flow in 2018, positive in 2019, and positive in 2020. They have 6.7 billion yuan of equity on their balance sheet. They raised 10.5 billion from issuing stock, and they lost 3 billion from running their business. They are a pretty young business, so it could take some time to get positive retained earnings. As long as they're growing their revenue, which they're doing, then I'm okay with negative retained earnings. Let's look at the capital structure. They have 1 billion of equity, 6 million of debt, so they're 99% equity, 1% debt. And their net debt is negative 989 million, so they have nearly 1 billion of cash on their balance sheet. And their market cap is 1.2 billion, which is unreal to have almost as much cash on your balance sheet as your market cap. And their weighted average cost of capital is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 3.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.6 billion. We divide that by 324 million shares. And we get a calculated stock price of $7.87. They're trading at $3.78, so they're trading at a 52% discount. It's a strong buy according to the model. The way I calculated their future revenue, it seems like their revenue isn't growing too much from 2020. So I estimated their 2021 revenue to be the same as 2020. And then after that, I increased it 9% a year, because that's the analyst forecast for their revenue to grow 9%. And it seems like their expenses are a little higher now, so I'm giving them negative free cash flow in 2021 and 2022. But as their revenue increases in later years, they should become more efficient. So I converted 10% of their revenue in 2023 and 2024 to free cash flow. That's about the average. When I looked at all the companies that I evaluated, which was close to 800, the average company converted 10% of their revenue to free cash flow. But I do think there's opportunity for them to grow a lot more. But even with this conservative estimate, I'm still coming out with a stock price a lot higher than it's trading at. But the big concern is not the fundamentals of the company. The big concern is about the Chinese government. Simply, Wall Street values the company at $4.27 a share. They're saying it's 11.5% undervalued. One analyst priced this stock, and their price target was $5. This is where the stock has been trading since 2019. So you could see it peaked at about $20 a share a few months ago. But when the Chinese government started interfering with Chinese companies trading on the American Stock Exchange and all these regulations, Chinese stocks took a huge hit. So the stock is at its lowest point ever. They have a beta of 0.74, so the stock isn't too volatile. It's down 77% in the past 52 weeks, while the S&P 500 is up 29%. The 52-week low is $3, the high is $21, and the stock is trading below its 50-day and 200-day moving average. 5.5 million shares are traded each day on this stock. Of the 324 million shares outstanding, 131 million are on float, 30% are held by institutions, and a little over 2% of the shares are shorted. So the stock has gotten killed the past year and past 90 days, but it's up the past week, so we might have seen the bottom. So the stock may start surging up. Analysts are forecasting their earnings to grow 123% and their revenue to grow 9%. If you invested $10,000 into this company when it IPO'd, you would have been up to $15,000 at one point, but if you're still holding on, you'd be down to $3,300 today. That's a 67% total loss. So if you were bullish on this stock last year, you should be super bullish now since the price has come down so much. The video game giant Tencent owns 37% of the stock. The founder and CEO of the company owns 15%. The next shareholder owns 5.5%, then Capital Research, then Infinity Capital. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. They have an amazing price to sales ratio. It's below 1. That means their revenue is higher than their market cap. And they have a really good price to book as well, 1.2, so they have a really solid balance sheet. They have a high current ratio and quick ratio. They have a ton of cash on their balance sheet. These numbers are in Chinese yuan. So if you wanted to convert them to US dollars, you can just divide by 7. The company is really well capitalized. They have nearly $800 million of working capital. The best way to look at ratios to compare them to companies in the same industry. Right next to DouYu is DouYu, and the average for this entire industry is down here. So if DouYu has number in red, they're worse than the average. If they have number in blue, they're better than the average. So we can't look at their PE because it's negative. DouYu is doing much better in price to sales and price to book, so they're bringing in more revenue relative to their market cap. Both companies are higher in current ratio. Of course, DouYu has negative ROE. DouYu is positive. Both are really low in debt. And DouYu is twice the size as DouYu. So to summarize, I have them trading at a 52% discount. This is just another Chinese stock that's severely undervalued. But the problem is not with the company, it's with the government of China. I'm pretty confident they're not going to interfere with these companies making money. Because any government needs money, so they need companies to generate money and profits. That's how governments run, on taxes. But who knows when people will feel comfortable buying this stock and driving the price higher. It could be this year, it could be in 5 years. But this stock has to go up at some point because they do have good fundamentals. Like a lot of these Chinese companies, Alibaba, Baidu, they should all go up eventually because they're so undervalued. I rank their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.